You are listening to Mining Stock Education.
I've got a very concentrated portfolio. I'd much rather put more money into Kenorland, my biggest position, than I would to doing a spec like that. And it's just because of the confidence I have, my understanding of the company. And there's numerous companies, not just Kenorland, but I bring them up because it's my biggest position.
Welcome back to Mining Stock Education. And today's show, you're going to get to hear a chat between two investors, myself and Brian Leni, a conversation talking through how we go about investing in this sector, recent occurrences and things like that. Conversation I wish I would have heard about 10 years ago when I was trying to vacuum up all mining investment related content on the internet, which eventually led to me starting a show, Mining Stock Education, so I could learn more and feel like I've picked up some knowledge and had some successes along the way in the past decade. Brian, let's start with the question of, would you invest in a lifestyle company? And if so, how widely would you make it be known that you're investing in a lifestyle company?
Yeah. So I'm glad you put that in quotations because it certainly wouldn't be an investment. I've learn't my lesson, at least I think I have, in terms of investing in companies that have that sort of component. I say learned my lesson is the lesson I learned was I thought that the situation was different. But as we sort of talked about in previous discussions, a scorpion is always a scorpion. And so that's something I sort of take to heart and I hopefully don't do again. So would I do like a short-term spec? I probably would. Would it be of a position of significance? I highly doubt it. Like it would be something where I knew I could get in and out of the position really quick. And I would have to be related on something I thought I knew or understood about the company that I could take advantage of. But those are few and far between, and so I would much rather invest in companies that I know really well, have great management teams, and I know the investment thesis, not the necessarily full out spec thesis. So highly unlikely, and I definitely wouldn't tell anybody. How about you?
I might take a punt if I can recognize based on my historical experience where, okay, this is setting up for a run for these reasons, even though I don't trust management. If I did, I wouldn't talk to management, do due diligence. I had several just Zoom calls with management this week, be at a conference next week. But if I'm interested in a lifestyle company, you can kind of discern that from afar. Especially if you've been in this sector looking at things, you read the MD&A, you go over the financials, watch a couple of YouTube videos, see their marketing spend, and you can kind of pick those things up. So in those cases, it might be a trade, but whereas I might have did it 4 or 5 years ago, I'm honestly not even as interested in that as much more. I'd rather invest in fewer companies where I can talk to the management, feel like I understand what I'm buying. So, throwing 10, 20 grand at a little lifestyle company, hoping to make 40 to 60% over 2 months, like that doesn't interest me as much. But right. Would you do a life financing? Okay. And for those that don't know, life financing are where there's no hold, kind of like in Australia, the Canadian markets, you can raise, I believe it's up to $5 million, no hold whatsoever on the stock, no 4-month mandatory hold after you do it. And then it usually comes with a warrant. So you see guys buy the stock and usually sell to regain their initial capital and ride the warrant. Brian, I'm not doing private placements virtually at all anymore as a U.S. investor because they made it too tough for me. But would you do it?
Absolutely. I don't see much of a problem investing in a life financing, especially if I like the company and I'm interested in expanding my position or starting a position. I think that can be a great way to enter the investment. I think, depending on the situation, sometimes those can be sort of problematic. But overall, whether it's, a no hold right away or a hold after 4 months, you sort of have the same things that can happen. People clip for the warrant, or if there's no warrant, begin to sell into any sort of strength. And that's always a risk. But in terms of life financings, I have no issue with them. And I think probably the bigger question is something that I've covered in some other conversations I've had and interviews I've done on MSE. Warrants is probably the bigger issue out there, and is more indicative of trouble in the years ahead when you have these large warrant overhangs, and how it can really destroy value in a company, and it can definitely impact the people that aren't able to participate in the financings, which is probably your general retail investor. So the warrants is probably the bigger part of the question, and part of the sort of concept or theory behind how companies raise money in the future, whether that should be a part of it or not.
So I was talking to a U.S. listed CEO of a miner recently, non-Canadian. And one of the things that they bring up is that all the shenanigans you can do in Canada, basically on the CSE and even the TSXV, which is a little tougher than the CSE, but still like the shenanigans aren't significantly punished versus if you're dealing with the SEC. Like people put out content and say not for distribution in the US because they just want to be able to say, I don't want to deal with FINRA. I don't want to deal with the SEC. So I bring that up in the context of, with these new financing mechanisms, people talk about, the financing structure is broken. Is the financing structure broken, or is the whole sector broken with the way people operate with little slaps on the hands? What's your take on that?
Definitely there's people that are doing stuff that really ride that line or cross it. And that's probably where the root of the problem is from my perspective, that the people that are actually doing wrong in the sector aren't really getting any sort of penalty, or the penalty isn't significant enough for them to stop. It's just, recalibrate and just do it a different way. So I would say that's probably the bigger issue. The other side to that is, like, I'm a libertarian at heart. Like, I truly believe in self-responsibility. And I think that some of this stuff gets a little bit crazy in terms of the liability, in terms of, investors not being able to make decisions for themselves, or don't do the due diligence to sort of figure out that, they're dealing with a lifestyle company, or they're dealing with something nefarious. Now, not everybody has the same access to information. And so it gets a little bit clouded, and there probably is a degree where that sort of mentality doesn't hold up. But I would say there's a balance there between people having their responsibility with themselves to not just act on anything that they hear on the internet or from some talking head, and then blame it on them if it doesn't work out. The side note to that is those people that do have that sort of nefarious or ill intention in mind, that when they do something like that and it's proven that it was not above board, that they have to get more than a slap on the wrist, where the risk there has to be big enough to dissuade people from doing that. So it's a balance, and it's a very indicative of where we are in this world, and maybe a direct reflection, especially in the U.S., with the SEC probably being or FINRA being the most stringent out there, and what that reflects of American society, and sort of where liabilities are, and maybe that risk of suing just amongst people in general has much more prevalent than US and Canada. And that's something that we've talked about in other conversations about other things. But it's definitely a different mentality between, let's say, the US and Canada. And again, it's reflective of where we are in today's world. And I think there's blame to be passed around.
Mm-hmm. So there's a geological belt across Alaska into the Yukon, right? So if you have deposits in that whole belt, and you were given a binary choice to invest in Alaska or Yukon, which one would you go with? And I'll give my answer. I've talked to a couple Alaskan CEOs. I'm American, but I wouldn't just invest in America first for that reason. But I think I would invest in Alaska, especially under the current administration. And some things I've been told that a lot of the sentiment and the push from the government to promote mining and Alaskan mining is real. So I like that upward kind of trajectory of the jurisdiction. Whereas the Yukon, although minerally endowed, with the Eagle Mine disaster, Victoria Gold's issues there, I do think that puts a damper on it. And I know we talked with Rick Rule. I believe we interviewed him together, or I interviewed him, whatever it was, but he said that he likes the Yukon. Were you on that interview when he said he likes the Yukon? And no. Okay, then I must interview him by myself, sorry. But he said that he thinks it's a short-term sell-off, and overall, he'd be a buyer. What would be your take here, Brian?
It's such a hard question in terms of like making it binary. I understand why. And I guess my initial inclination is to agree with you that Alaska, just compare without getting into any detail, Alaska would probably be the one that I jump to. And I would jump to it sort of in relation to politics. And I do think for whatever reason, it might be easier to get something through in terms of permitting and, getting something into an operation in Alaska than it would be the Yukon. But, none of these situations are binary. They're all different, and you have to sort of look at them as an investor individually from my perspective. I think the big thing, having been to the Yukon back in 2018, I believe it was, when I did that week-long site tour visit, amongst a number of different companies, the contrast that you're making maybe between the Yukon and Alaska is one of infrastructure, for instance, road access, power, internet. These are things that are not in widely held in the Yukon. Whitehorse is by far where the most population is. There's logging roads and stuff like that allows you access to some of the more remote places, but really it is extremely remote. Like I can remember back in 2018, one of the big things they were touting is that they had extended the fiber optic lines around the top to the Northwest Territories. So they had a complete loop now, whereas they only had I think it was one loop in from the Northwest Territories that brought internet in. So if that got cut, if there was a problem, they'd basically be blacked out. Other than that, so this loop enabled them to receive an internet signal from both ends, and this is a really good thing. But really what it was is a big indication of how far they are away in terms of infrastructure. You got some great companies, and I think this is probably what Rick was talking about. Snowline has made a world-class discovery. It looks like this is going to be a mine in the future. The big question is when. Now, when questions are great, but having been in that area of where Snowline is, and I was there to see Attack, which was, I think, just northwest of where Snowline has made their discovery, you're in the middle of nowhere. There's no road access. You have to fly in. You're probably going to cross a number of First Nations. And again, I'm doing this from time, I'm not exactly sure, but you could be crossing a number of First Nations areas. And so this is where the complications come. And I think, again, if you're looking at these sorts of situations, you look at each one of them individually and make your decision based on that. And I'm sure Alaska has the exact same pitfalls depending on where you are in Alaska. And but again, going back to your question and the binary of it, I would say that Alaska, the perception to me at least, is that it might be easier overall to have something actually make it to a mine. But then again, as we both know, there's a couple, whether it's Pebble or even one that I believe that was associated with you early on, Trilogy. Yep. They've had their issues too, right? So it's not one of these things where it's just isolated to the Yukon and the issues at Eagle. There's each of these situations is so different, and it's super hard to be binary in anything that you do in the resource sector.
Yeah, like you brought up, you have to bring up the nuances. We didn't, so you can have general guiding principles, but the more you experience this sector, you're going to let that be tempered by all the nuances and the caveats, right, that goes into your due diligence process.
Absolutely.
So next week, I'll be at a conference and have a bunch of meetings scheduled, including meetings with CEOs with projects and jurisdictions I know nothing about, some of which aren't known for mining, but at least based on my initial research, it could be at a turn. And I know that from interviewing people for the show and talking to people in person over the years, when we talk about the cyclicality of things, we can't overlook the cyclicality of mining jurisdictions at time, right? People liked Ecuador. Then Ecuador didn't have a favorable structure for mining companies. And then it became more favorable, and you get, Lundin Mining just growing this massive underground high-grade gold mine. And now people at least will invest in Ecuador, and the share price goes up, right? So you have to pay attention to the cyclical turning from favorable to unfavorable, back to favorable within jurisdictions. Like you're invested in Argentina, right? It's a little more favorable now. Same thing. You get to benefit from that. So I'm looking forward to these interviews, not even project related, but just because jurisdiction related, I'm going to be asking a bunch of questions. So how do you go about looking at new jurisdictions, at least new to you? What's that due diligence process look like for you?
Bill, it's a really interesting question because it's something that's really changed for me over the last 9 years. I've been doing this, as a full-time sort of occupation. The things that still exist is I still do a ton of reading on whatever jurisdiction I'm investing in and try to sort of understand the culture there, the economics, where mining sits in that sort of hierarchy, sort of look at what other companies, so is there other juniors there? Are there senior producers? What does that hierarchy look like? And is there an established trail of mining going from exploration and discovery all the way to development? And I think that's pretty important to see at least a basic structure of that in any jurisdiction. The one thing that has changed for me, and while I do agree that there is a cyclicality to many of these jurisdictions, Ecuador being a big one, and it's something that I benefited from trying to invest at the bottom and go at the top. The thing that I think you need to maybe experience, and if you can take my word for it, then that's great. But cultures don't change, and many of these countries just don't change. Those risks are always there. They're just sort of in a different form. And that sort of plays into the cyclicality, whether they're moving from a left-wing government to a right-wing government. You may have 4 years, maybe you don't. Maybe you still have those same issues that come up despite the left-wing government or despite the right-wing government that still pop up. And there's that locality. And so I don't put much stock into thinking that people are going to change and this thing is going to be good for an extended period of time. I expect everything that I saw before mostly to be a risk in the future. What's changed is probably, and this is more of just what the focus is, if I'm going to go into a risky jurisdiction or a more risky jurisdiction, I want to be sure that I'm buying something that's very cheap, where my price to value ratio is well in my favor. Not that it can't get cheaper, but that it's well in my favor, that I'm being sort of paid to take that risk. And if management has that experience and they're able to execute on the action plan they have, then I'm going to get some share price appreciation or some recognition from the market. And if the jurisdiction is sort of hitting that upswing, which you sort of hope you do, along with maybe a market upswing, maybe you can capture that delta. I guess what I'm saying is that, you do the due diligence, you read as much as you can, ask questions, but I don't really expect to see anything much different from a jurisdiction, because it takes years and centuries for cultures to truly change. And really, you need that differential, that price to value ratio in your favor to ensure that you're giving yourself the most differential to sort of wait out those times when things get bad, because they invariably will. And the last thing is that any jurisdiction or every jurisdiction has political risk. It's ubiquitous from my point of view, whether it's Canada, the States, Ecuador, Africa. You can lose money in a variety of different ways based on the politics and the locality of risk. And it's always there. So you have to be mindful.
So were you following the Alphamin issue with the terrorists and the DRC, and how it sold off so sharp? Like, there was diehard tin barons that loved that stock, and then it sold off. And then I was almost going to buy it, Brian, not having followed it that close. I guess this is an example of, like, would you buy something even from a distance, even if you haven't done extensive due diligence on it? I almost bought it. I didn't. But, like, what's your take on something like that, where everybody says tier one, but the DRC, right? There's an issue. So you're basically betting that this situation is going to resolve, at least for you to scalp 30 to 60%. Like, would you take a bet on something like that?
The DRC is just tough, but it's sort of balanced by the geological potential, which is obviously amongst the best in the world. I would say probably not, and I would say even though everything in the resource sector is probably is definitely on the riskier scale, I would say I'm still more risk adverse in terms of I like to have a better understanding of what I'm betting on, and in terms of something like that short-term drop, it's very intriguing, especially if you know some basics about Alphamin, and that there's just not a lot of tin producers out there. The grade and the production is decent, but if I didn't understand exactly what was going on and what the probability of that situation changing and whether it changed on a dime, again, I think the longer I've done this, the more focused I've been on just focusing on the things that I know. And that's, I've got a very concentrated portfolio. I'd much rather put more money into Kenorland, my biggest position, than I would to doing a spec like that. And it's just because of the confidence I have, my understanding of the company. And there's numerous companies, not just Kenorland, but I bring them up because it's my biggest position. I'm obviously biased, but that's just how my mind has sort of changed. And that's as a result of both losing money and understanding how much I just don't know about anything, like whether it's the sector or certain companies. Like, you really have to be laser focused to have a good understanding, I think, of these companies. You can't be, I don't see how anybody has a 40 or 50 company portfolio and fully understands all those companies. And not only that is even if you're right, in some of those things, and you have a 1% or 2% allocation, how you really make a discernible difference in your portfolio. Now, everybody's different, and so for some people that works. Just for my mind and my perspective, I've definitely shifted.
Kenorland's a sponsor of the show, one of the few sponsors we have right now, and so Kenorland has cash incoming, but it's not like a producing cash flow. So do you want to break that down for people that aren't familiar with that company, Brian? Maybe why is this your biggest position?
Sure. Well, for me, it's a balance to risk to reward. And I think if you look at their news flow, especially, they just released some news this week about future project generation. So essentially what they do is they've got a technical team that's got a very, very high technical geological acumen. They generate projects. They focus on discovering deposits undercover. And they've done a fantastic job of this. And really, if you look back to their RTO or their IPO going public, they did this on the back of the Renault discovery in Quebec. And since then, that 20% position that they had, or 30% position, whatever it was in retrospect, is now a 4.5% NSR on that discovery that Sumitomo now full out owns. And that'll one day hopefully be an operating mine, and that royalty will be absolutely worth something. But they haven't stopped there. They've just continued with that mentality of generating projects and JVing them to senior mining companies. And they've got, I believe, probably 4 projects that are being drilled right now, and we should see results from them over the next 4 to 6 weeks. And then they've staked and bought out a couple other packages in Ontario and in New Brunswick, that they're going to further do this. They'll do some groundwork. They'll prepare the sites. This is probably, I think V1 is VMS, exploration undercover. They'll come up with some targets, and then, of course, go to their extensive list of senior mining companies that they have contacts with and see if they can joint venture it. And again, so this business model always continually has projects that are being drilled. It's being drilled with the senior mining companies taking the majority of the project plus a spend, and usually Kenorland's taking some sort of management fee, which can be up to 10% of the spend, which pays their salaries and really brings all that value back to shareholders. And that's why they've got such a strong cash position. And to me, is the reason why I'm so comfortable adding to that position as we go along, and why I would always be comparing. But it's not just Quorum, but those positions that I have and really know well, I would much rather keep on putting money into them, even if it's at higher prices, because I see the value proposition as it stands today and sort of where it could go in the future. And so to me, Kenorland, again, is like one of those standout positions, considering the management team, considering the business model, that I'm very comfortable with continually putting money in.
So, you know how recency bias affects our analysis of things. Having lost 80% in my most recent Explorco speculation, the business model makes all that more sense to me. However, I have had a company, I did 26 cents with a 40-cent full warrant, and the stock went to like $1.52, right? So when you get that, you're like, why would I mess around with a prospect generator? I'm talking about recency bias, how it affects you. And then I had a nice win, 30-cent placement with a 50-cent half warrant, and that stock ran well over $1. And you do that, and you're like, oh, I can figure this out, 8-bagger, 10-bagger in 18 months, let's do it again. And then you get I've had 90, 80%, 70% loss, and you're like, okay, the prospect generator makes sense. But you're literally saying, like, your biggest position is not in a producing company. It is in a prospect generator. Like they have revenue, but they're negatively cash flowing. So they still either, issue shares to corporates or somewhere but overall, like the dilution is so minimal relative to the value that's being generated. That's the thesis here.
Yeah, and like I think again, it comes down to those stories that I think I really understand. And while I like the prospect generator model, I'm the first to say I don't think it's go out there buy any project generating company that's out there. I'm very much against that. I think you need to go story by story and sort of look at the nitty gritty of the company, compare the price to value and where that company is headed. And again, if you invest in good management teams that have that price to value ratio in your favor, to me, these are just a matter of time. It's not as big of a question mark as if they're going to be successful. It's just when they are going to be.
But I've kind of challenged you on this offline before. Like, what about some of them that we've talked about? We don't need to name them, but I'm like, Brian, well, how is that not a lifestyle company? Like in 2015, when I just got in the mining sector, this guy was doing YouTube videos and the market cap is the same a decade later, but I see him at conferences, nice hotel, nice flight, nice conference. So like, it's a nice lifestyle. He's probably made $2.5 million in salary and benefits, traveled the world, and the market cap is the same. And the shares are lower because of the dilution. So what would be your response to that?
Well, again, I continue to lean on each company is going to be different. And, there's some of those companies that, and this is what I mean, that could sort of trick you into thinking that there's more value or it's a safer bet. And truly what they are is lifestyle companies. And, if I'm thinking of the company of what you're laying down, I would agree with you. The more I think about it, the more I agree with you. I never invested in them though. And I'm glad I didn't.
But you stuck up for him a little in our
I did.
back and forth.
Right, I did. And that comes down to it shows you. And honestly, I check myself because there's certain people that I sort of enjoy talking to from time to time, and I probably give them more of the benefit of the doubt in certain terms. But I'm still pretty good when it comes to actually investing my money. That I do think about it in more context. But I'm glad that, and this is why these conversations are so important to me, and I think to anybody. Like, it shows you how important a network is because, putting these ideas out there and having your friends who should be questioning you to a degree, and it should make you think, and it continually does that. And so in that circumstance, I do agree with you that it's probably more towards that. There's some more nuance after we did have a discussion about it that I think let him and that company off a bit. But I don't disagree with you. Like, I do lean towards it's more of a lifestyle company, and I know people are probably upset that we're not naming it, but there's no value to be gained from knowing it, because the one thing I'll say about the guy is that I don't think you necessarily are going to lose money with him. You're probably not going to make any, but you're certainly not going to lose. And so it's just whether you want to support that sort of what he's doing. And again, I wouldn't suggest you do, but so. I think it comes down to the company by company basis. And when you find good investments, to me anyways, I want to go full bore. I want to give a higher allocation to those guys. I want to follow them closer, and I'm always comparing new investments to those ones I hold in high regard. And if I can't discernibly make a thesis or come to an understanding of why I'm putting money into this new company outside of the ones I know exceptionally well and have this differential, then they just don't enter the portfolio. And that's the way I operate. But this brings up a good segue into a question I have for you. And it's something I was asked in the newsletter just last week or the week before. And it was a subscriber asking about a company that I just basically invested in this year. And he said the insider ownership is low or lower than he likes to see, and why I was comfortable with that. And I came up with an explanation. But I wondered for you, what's the importance of insider ownership? And is it a big enough factor for you to just say a full out no if it isn't high enough?
I would say generally yes. However, there's situations like with Hayadon and Corex Copper where they're not the founders like they were with Osino, right? And they're taking over a project and an issuer from others, cleaning it up. optimizing the project and he doesn't have founder shares, and maybe he doesn't have the full allocation of shares that he would like to get. In those cases, here goes back to trust and experience. Because I've made money with him in the past, then I would likely trust him and say, okay, he said he's going to acquire more. And then having spoken to him over the years and knowing his motivation, I know he really wants to make other people money. I know he enjoys doing what he's doing. I know there is this career, another notch in the belt, motivations. So in those cases, I would feel comfortable. In other cases, when, I've IR firms set up one-on-one meetings with me for like a pre-IPO company or a company that just went IPO, you always ask the questions, okay, what's your average cost basis? How much cash out of pocket did you put into this deal? And then you try to politely say like, okay, you put in $375 cash into this deal. How meaningful is that to you, right? And I've had CEOs tell me, Bill, like, the $1 million I put into it, that's my retirement. It's going up in flames if this thing burns down. Right. So you got to like that. But you and I know other guys can throw around $1 million because they made 20 on the last deal. And, it's just something for them to do, this next issuer, right? And they get to go hang out with their high school buddies. It's like a high school reunion at some of these like when I started going to these mining conferences as an American, not from the sector, I'm like, this is like 50, 60-year-old high school reunion time. That's the way it felt with everybody getting together and drinking. And I'm not trying to poke fun at it, but at the same time, it's good to hear an outsider's perspective, how they first experience it. And when you see that, then you say, you guys having too good of a time at the shareholder's expense. I'm just saying you should be asking that question. So it is an issue, but it's also, what does that position, like, what does it mean to them individually? And you kind of pick that up through conversation. So understanding all the nuances, you have to dig into it, but then you could also just come up with your own metrics. Like for a $7 million Explore this is what I believe a guy could pay himself, whatever. 150 plus some incentivization, right? For a job that you and I probably would say is part-time or half a year, right? So you have to come up with your own standard of what you think is normal. And if he doesn't have a big position that he bought, but he's paying himself $375, I remember seeing a lawyer out of Toronto. This was like in 2020. I don't even remember the name of the company, but when I researched it, the lawyer that took over an Explore, he was paying himself $1 million a year for a junior. And you see something like that and you're like, I don't care if you made $1 million a year as a Toronto lawyer, you can't pay yourself $1 million a year salary and bonus cash, Brian, cash, running an Explore. So you see somebody like that and they don't have much insider ownership. You're like, no. If I see another guy that this is his first gig, he's 32 years old, he's willing to hustle, he only pays himself, let's say, $150, he wants to acquire more, but the board wouldn't give him the RSUs that he asked for, maybe I would take a punt on it.
Yeah, that all echoes with me. Like, to me, I essentially said that if you were going to make a rule for yourself, and this is something that I've done in numerous aspects, especially early on in my investing career. Like, I literally had a piece of paper to my right that had the sort of set rules that kept me in a framework for decision making. And I think this could be one of them, where you, as an investor, especially if you're new, you could say, hey, look, if they don't have more than 5%, they don't more than 5% of the company, then I'm just not even going to pay attention. And I think, again, for especially for a newbie, that's probably not a bad rule to have, because it gets rid of some of the nuance and some of the stuff that I think you probably need a little bit more experience to discern. The other side to that is, for me or you, it does seemingly lean to be a case by case basis to an extent, where, if it's really egregious that, the position, there's just basically no insider position or weighting towards, or an evening of between shareholder and management, then, probably in any situation, you're probably not going to even attempt it. But for me, in the circumstance of the company that I was talking about, to me, the value proposition was exceptional. And I thought, I definitely didn't go unnoticed, but I thought, what, they've operated the company over the last 10 years, very judiciously. And while their insider ownership isn't huge, to me, it's worth the speculation given what I know of them and how the company is positioned to try to capture that differential. And when you start getting up closer to fair value, then maybe that is definitely a time where that insider ownership becomes a bigger question mark for you, or you pick wherever that point is. But for me, it's a case by case basis, and in this particular situation, it was like that differential is just so high, and what I know of the company and how they've operated, I'm comfortable, at least for now, for there to be that sort of disconnect between shareholders and management. So
you get a lot of IR firms and so forth wanting to set up meetings for you to talk to CEO so you could see it, maybe recommend it in your newsletter. Okay, I get some of that too. What's your due diligence look like after that initial call? If you're saying, okay, this is at least worthy for me to go to step 2 of due diligence after the call, there seems to be enough meat on the bone that I might want to look at this more. What does your due diligence process look like on that individual?
So for me, if something does spark, and I usually I know, there's a couple slides in particular I want to look at. Obviously, the management side, who's else is in the management team and who's on the board of directors, and then I want to see the share structure, which invariably gives me an idea of their cash position, what their market cap is, and sort of what the share structure looks like, fully diluted versus your regular running market cap. So if that stuff checks out, and then that initial price to value seemingly is in my head, probably the first thing I'm going to do, depending on what type of company this is, like if it's exploration versus development or prospect generator, I'll probably go to their website and try to look at more in depth, probably at the project. That's usually what I'll do first. Then I will start asking questions to my network. There's a couple people, so one mentor in particular, I'll probably send the name to and see if they know that particular CEO, if they've had any experience with them, and just see what they say. From there, that usually cuts a lot of names out. And usually when I go to the website, do a little bit more due diligence, particularly on CDAR too, looking at how they've structured their salary, these things that we're talking about, insider ownership. Those things, again, will be the first places I go and sort of change the way my mind is looking at it. And then from there, again, you get more into the project, doing my own analysis, whether it's discounted cash flow or coming up with some sort of valuation, and then maybe even doing a follow-up meeting. One of the other things that I've kind of hyped on in the newsletter too is the importance of those in-person meetings. Zoom definitely did a lot of good during COVID, and it still today connects. I don't live in Vancouver, and that's where a lot of these CEOs are located. But I tell you, when I get to meet these people, I was in Vancouver just a couple of weeks ago for a conference, and I got to meet some new people and just reacquaint myself with some people, existing position management teams. There's nothing that beats meeting these people in person, spending some time with them. And it can't be discounted how valuable that is. And so I just reiterated it to, my readers, that you need to be going to conferences. If you want to take this seriously, even if you have to travel to the conference, if you're not located in Toronto, Vancouver, maybe Zurich, London, these big mining conference sort of cities, you should be traveling to the nearest one and trying to hit those conferences so you can meet these people in person, because, and maybe this is part of the feel of understanding people, but I find that I get a better judgment of people when I'm meeting them in person and sort of speaking off the cuff rather than when it's all formal over Zoom. And so that's, again, how I've developed as an investor, and it's sort of how I see it. But yeah, it's the website, CDAR, how that company's structured, and then asking my network, and in particular, a couple of people that I really trust and have been in the business long enough that they know a lot of different people. And so I'll throw the name out to them, and really all that feedback plays into how deep I'm going to go with my decision making. But ultimately, it comes back to me, and it's my fault if I make a mistake.
Okay. I'm going to share one of my mistakes and then ask you a question. So, project was brought to me, a company, pre-IPO, and I had someone in my network that I reached out to who actually knew that project, okay, and knew the history of the project, who knew the jurisdiction better than most people you could call, he said, Bill, I recommend you don't put money into this. So what did I do, Brian? I put multiple six figures into it, right? And it was a huge mistake. So would you, if you get someone in your network that respects you, will give you the time of day, if you get somebody in your network that says don't do it, how would have you historically responded? What would you think? Would you just avoid just because they said avoid?
There's a lot to this question. I would say this is like, mentors have played such a huge role in the success I've had. I would say all the success is related to those mentors and the lessons that I've learned. Unfortunately, I think that some lessons just have to be learned by mistake, and there's no way around it. No matter what anybody tells you, no matter how much you respect them, there's just some things you have to learn. And sometimes it's not even necessarily that direct, not disregard, but sort of fluffing off maybe what they say. Sometimes you think that you're sort of following them, but when you really think about it, you're like, oh no, this was my mistake and this is what they were telling me to avoid. But, given the mistakes I've made and looking back on what mentors have been able to give me, 100%, it was basically a disregard, and I had to learn those lessons myself, and I had to go to those lows in terms of my confidence in myself and the money that I lost before I could fully realize, again, I sort of what I think you're alluding to is, if that person says something to me again, that I better hear or adhere to what they're saying. Again, I don't know if anybody can necessarily do it. Like, you want to learn from other people's mistakes, and whether people listen to us and they gain some value. You can't, and there's another quote, and I'm going to butcher it. I used it in a presentation, and it basically says is that you can't comprehend or uptake information until you're ready. And for a lot of people, that just echoes exactly what I'm saying, is like, at a given time, you're going to listen to us, or you're going to listen to anybody else, and you're going to pick out things that you're ready to hear and you're ready to absorb and learn. And other things are going to go right over your head, whether you comprehend them or not. And then you'll make a mistake, and then you'll be ready to bring on more information the next time you listen to those people. And again, this is the iteration, I think, of being an investor. It's the iteration of anybody's life, is these sort of mistakes, or one step forward, two steps back, step forward, two steps back. And I think it's unavoidable. And it's something, that I hated losing the money and making the mistake. In retrospect, I could never be where I am today without making those mistakes. And so, I'm glad I did. I think you want to make those mistakes probably as quick as you can without blowing yourself up. And that would be the thing that I heed the most is, you can't let fear of making a mistake prevent you from doing something, because then you absolutely go nowhere, and your growth just is never achieved.
Okay, so 2 of my growth points as a result of this and other experiences have been my last 2 development companies that I've looked at and invested in. I hired a QP, a qualified person, to do his own independent report. Cost me like $1,500 US, and give me his analysis, and was able to ask him questions, have him point out the flaws of what he sees. This is someone with decades of experience. That's a QP for these economic studies. And so I put someone like that in my Rolodex, to use an old-fashioned word, that I reach out to. Also, I have a lawyer now too that for about $3,000 will do a background check on guys for me. And there are companies, like when these big firms, and this, I'm sharing this for the listener's sake, there are these big firms, and I've been told this by people who invest large amounts of money in this sector, they'll pay $30,000 to do a rectal examination on the management team and the lead guy, like learn everything about him, and send PIs everywhere. And they'll get that report before they'll make an investigation. And then they'll hire their own engineers and spend another $30,000 having their engineers look at the raw data and coming to their own conclusion. Like, so I'm not willing to spend $60,000 on a potential investment, but I am, Brian, now willing to spend $4,500 in addition to reaching out to the free people in my network. Now, people may be listening to us and say, whoa, like this is a lot of effort. And that's part of the point I'm trying to get across. Like, it's a lot of effort. If you want to make money at this, like, unless you come in a roaring bull market where, like how I started, you make money really fast, even when you don't know what you're doing. But then once that cycle turns over, like the lessons start. And if you want to be in this and play the cycles, though, you need to put this level of due diligence and even money at work in the due diligence process, right?
Absolutely. Absolutely. And again, that's like you say, it's not a position that everybody's going to take, but what the important thing is just to learn is that you have to do something. You have to start learning. You have to start participating. And if you don't, you can't expect anything, wins or losses. And yeah, then the more successful you are, the more money you can deploy. And that's exactly what you see. It's sort of that sliding scale upwards in terms of the more money you have to deploy, the more you have at risk, the more you need to protect that downside. And that's exactly what you see from those big players. They need to do that because and don't forget, this is the other thing about the resource sector and why allocation is such a big topic, because, for when you're talking like, let's say sub $1 million portfolios or sub $1 million positions, well, even I should say when you get to the position size, like sub $100,000, you can come in and out of that position. Some of the juniors are so illiquid that maybe you can't. But when you're taking $100,000 plus positions, these are long-term bets. You're not going to be able to sell $250,000 without really impacting the share price, or you really need that liquidity event, which sort of leads to why some of these companies end up doing these sort of pump and dump style marketing campaigns, is because these guys with bigger positions, and this is where the nefarious side comes out sometimes, is they need that liquidity. And so they'll pump the marketing side so that they can have those moments where they can extract big quantities of stock. And again, this is how the process works. And again, those guys on those bigger ends of thing that are doing $1 million positions, these guys are taking positions that are 5, 6, 10 years out. They aren't the 2-month spec on whether on a drill hole, right? You're taking more, and this is where again you truly are investing more on that team than you are on the project, because the reality is that projects, the odds of discovery are so low that you need to pick teams that are going to give you multiple kicks at the can over a period of time, because statistically, this is what proves to be the way to do it. And you listen to, guys like Rick Rule talk about project generation companies and his hit rate. The math starts to really work. And again, it's not ubiquitous. You don't go out there and buy all the prospect generating companies. But if you pick the right companies that are run by the right people, typically these are the sort of investments that are going to give you a return over time. But again, nothing is ever for sure in this business.
Okay. In last month's episode, we played a game of scam, shady, or strategic, where we discussed scenarios and we said, is it a scam? Is this just shady? Or could this be strategic? Now, with these, like you said, pump and dump campaigns, big marketing spends, okay? The more you talk with people in the know, the more you learn. And like part of our journey is learning just by sitting down with people, going to dinner, being at the conferences, right? You pick up things. And so a CEO runs a big marketing program, but maybe what you don't know is that he's got a guy with a huge position, and that guy went to him with an ultimatum and said, you either get me a buyer for a cross trade, or I'm blowing out this position in 20 days. Okay, Brian, stuff like this happens, all right, based on my conversations. So then he's like, oh my goodness, what am I going to do to absorb that large of a position? But he calls his buddy. He said, I don't know, hire this guy. Pays him $350 to try to generate the liquidity. And then he calls the investor back. He said, okay, starting on this date, but please just don't exceed 20% of the volume, but I'm trying to up the volume for you so you can get off the stock. So you get a scenario like that. could that be strategic? Because like even that huge marketing campaign with maybe a nefarious group, it didn't originate within the CEO, but he felt handcuffed to do it. And I know of scenarios like this.
Right. Well, I guess on your perspective, I've definitely in the last couple of weeks have been sold on the idea that it's strategic. I just don't see
by management team.
Yeah.
Okay.
Yeah. Where they were trying to sell the idea that large marketing campaigns continuously over time will pay for exploration and ultimately discovery. And I've never seen a scenario where it necessarily works. I suppose there's some strategicness to that. But when you start to use more of these marketing companies or whoever that create the volume on these like crazy ideas, and it's usually just short term, and the stock charts, you thought you were protecting it and you got that guy out that goes up and that's great and the volume is sold, and then it craters like that. It truly looks like that mountain where the value is just never retained. And what happens is, I think, especially for investors on the outside, especially for investors that have been in this for a while, depending on who you use for those marketing campaigns or what the actual story it is, it just makes them avoids. There's companies I avoid just because the people are synonymous with these sorts of ways of doing business. And I've never seen the value retained, and I think ultimately all it does is hurt the company. And so I think it's probably more strategic that you try to get as the good investors in your companies as possible, ones that have long-term outlooks that are sticky, that aren't going to put a gun to your head. So I think if you go back far enough, the root cause is always in companies were desperate for whatever reason. There could be a variety of them. They take money from whoever's willing to give it at whatever price. And then ultimately these guys stab them in the back with sort of, ultimatums like that. And so that the real problem or the real strategic was a mistake much further back in the line. And ultimately, I don't think these things add that much value to, so there's not much strategicness to them. That said, we've talked about it before.
Here's the caveat, right?
Yeah. Well, good marketing is an absolute must. You have to be able to tell your story and get your story out there to people. And the thing is just you have to do it with good people. If the share price goes up, that's a definite benefit. And if you're doing the right things and you're having success, then it's just going to be that icing on the cake. It's not going to be the only thing that drives it. And that's the thing is I think the mentality in the business, there's too many people on the company side or the management side that believe that this is just truly a mining of the market. It's just a financial way to extract money from the plebs. And unfortunately, there's been too much of that. And the bear markets haven't necessarily, even though they've been deep, but not deep enough to cut it completely out. And, hopefully, investors get smarter, can sort of weed these things out and hold management to a higher degree, and ultimately management having a higher standard for themselves, I think is ultimately where it would be best. But maybe it has to start with investors first.
Anything you like to conclude with sharing or asking me, Brian, as we wrap it up?
The only thing I would say is given all the stuff that's happening in the world right now, how do you separate noise from signal? Whether it's wars in the Middle East, whether it's, the politics, the political side, the tariffs, the other things that sort of come with Trump on the good and the bad, stuff that's going on in Canada, the good and the bad. How do you separate the noise from signal?
I guess I'll just bring it down to where rubber meets the road for me personally, like paying down debt this year, just eliminating some debts, which aren't, large or huge relative to my net worth, but at the same time, paying those down. And then whereas in past years, if I had money I was going to allocate, I would put it into, a speculative mining stock. This year, I'm more prone to put it into a hard asset. And so with all the uncertainty, like I just learned last night of somebody in my social network that lost their job and now is thinking maybe we'd move out of state. Like that's where people's lives are at. When that happens, then that fear, reverberates throughout the economy. So I guess just being more conservative, even as I have done speculative things with junior mining stocks even this year, but I'm siding more with like those funds, putting it into hard assets versus even like ultra speculative things.
Right. That's good.
And that's not like some insightful macroeconomic analysis, but I've interviewed the macro guys and I respect them, but you can interview two of the exact opposite macro perspectives out there all the time. And I know you're a bottom up investor, but I just, the money I've made has been in the micro. If you can get the commodity price movement right and then find some decent micro opportunities within the junior mining sector, that's where I've made my biggest gains.
It's good. It's good.
Yep. All right. Well, Brian and I, two friends and investors chatting. We appreciate your listenership. If you have some questions for us, you can put it in the show notes or reach out through the contact form at MiningStockEducation.com. It's a high risk, high reward sector. It's been good to both of us overall, but as you can hear us talking through today, there's also been a lot of pain points that we continually learn from. So we'll catch you on the next episode, and Brian and I will do this in about 30 days again. Thanks for listening.